QuickBooks Pro Plus Desktop 2022 OneNote presentation, Pay Sales Tax. Let's get into it with Intuit's QuickBooks Pro Plus Desktop 2022. If you have access to OneNote, would like to follow along, icon left-hand side, topic introduction, 8370, Pay Sales Tax tab. Also take a look at the immersive reader tool, topic introductions in the text area too. Same name, same number, but with transcripts. Transcripts that can be translated into multiple languages and either listened to or read in them. Same name and number as presentations as well. Topic introductions designed to give an introduction to the topic, provide screenshots, links where applicable, give accounting background to complement the presentations, and can be used to follow along with them if you don't have access to the software at that time. Closing the icon on the left-hand side, we're focusing in on the home page to start off with. We're looking at the sales tax little widget up here, the manage sales tax item in the vendors section. Sales tax being a little bit unusual because the sales tax accumulates upward as we make the sales documents, which is down here, the invoice and the sales receipts. If sales tax is applicable, then the sales tax payable account will be going up as we create these forms, and then we'll be paying it off with the sales tax, the managed sales tax little widget up top in the vendors section. Paying off a payable, that's why it's up here in the vendor section, because it's kind of similar to hitting the pay bill, which is paying down the accounts payable, the managed sales tax paying down then the sales tax payable. So if we look at the accounts that will be affected, it's pretty straightforward with regards to the journal entry. It's going to be a decrease of the checking account, in essence a check happening here, check type form. The other side is going to be decrease in the sales tax payable, a liability account. And we need to make sure, just a recap, to have the sales tax on. To track the sales tax, you'll recall it's in the edit dropdown. This is the preferences. We're in the sales tax here. We turned on the sales tax. We set up our little sales tax items so that when we create the sales receipt and the invoice, it will then be charging the sales tax to the customer. And then we're going to say that it's a monthly basis that we're going to be dealing with sales tax here. So that means we've done 2 months of operations. We're imagining, and this may differ from state to state and whoever's charging you the sales tax and whatever rules they are imposing on you, but it could run something like this. We're going to be collecting the sales tax for January, the first month, and then we have to pay the sales tax by February. So now we're at the end of February, and we're saying, okay, now I got to figure out how much sales tax I collected in January and pay it in February. So that's what we're going to be doing now. We also had to go to the items and set up the sales tax for the items that it was applicable to. And for us, we said that the inventory item sales are going to be the ones that we're going to have to charge sales tax for. So we turned on sales tax with regards to those items. With this is the actual item inventory part. And we turned on the sales tax indicated by the tax code. And then when we created the invoice, then we charged sales tax. And so tax is increasing. And remember, it's a little bit tricky because you could imagine sales tax working a little bit differently. In other words, what does an invoice do? This is going to be increasing the accounts receivable by the 530, the other side going to sales. And then we've got that sales tax. There might also be an inventory and cost of goods sold involved, but we're focusing here on the sales tax. The sales tax going to be increasing the accounts payable. The reason that's a little unusual is you might think, well, wait a second. Why don't I just basically increase the revenue line by the full amount that I charged and collect the 530, and then the sales tax would be an expense of sales tax expense, a cost of doing business. And the reason you could think about why that wouldn't be the case is because they're trying to say that the sales tax is imposed on the customer, not on you as the business owner, and therefore you're not really charging the revenue, you're just the tool of the government that is forced to be the collecting agent of the government, and therefore it's not really revenue to you. We charged the amount less the sales tax, and then that sales tax line item shouldn't hit the income statement at all. That means when we pay it, we're also not hitting the income statement with an expense, which is decreasing the payable. So a lot of times people get that mixed up and they say, hey, I don't see sales tax expense on my income statement. There should be sales tax expense because I paid sales tax expense, and that's because the revenue also not on the income statement. So if we go down here, there's no sales tax expense basically on the income statement. So if we go to our reports, this is the report center and the vendors and payables, and we run the sales tax liability. We could run it here for the January. And remember, January is the month which we're going to pay. So it's going to be later than that when we pay it. So it's sometime in February, but we have to pay the sales tax for the period that is ended. So those cutoff dates become kind of important. And then we're going to run the sales tax and be able to pay the sales tax. We're going to then go into the widget in order to do it. When you're in the widget, you can still run the same sales tax kind of report. So you can kind of run the sales tax report that you could also find in the report center. And then we could just do the process, the pay sales tax item down here. You put the dates up top. So we're going to put the dates. This is the check date and the show the sales tax due through January, even though it's February at this point in time, because we're paying the sales tax that has been accruing upward up through January. That's going to come out to the 2343.85. We're going to pay that. Once we pay it, once we process the widget, it's basically going to make a check, but a special check used by the little widget thing, which is going to decrease the checking account. The other side's going to decrease the sales tax payable. Here's the transaction. If we scroll down here, we got these little sales tax payable. It's still a check. So it's kind of like the checks up top. It's decreased to the checking account, meaning that's a check type form. But like the bill payment, it's a little bit different in the indication of the type, which is nice because it tells us, hey, look, you used a widget thing to do it. If I go into that check, here's the actual check. Looks like a normal check up top, but at the bottom, it's a sales tax payment type form. It doesn't have the two little tabs down here with the expense tab and the item tab because we used the sales tax widget. And that's the indication to tell us that that's what we did. So then we have the sales tax payable down here, still 553.7 left because that's what we've accrued upwards in February, which we're going to pay in March because we only paid the January sales tax in February that had accrued up for January. So here's the sales tax payment for it. So we've been accruing up the sales tax as we make sales with invoices and sales receipts, and then we paid it off with a little sales tax widget, which is basically a check type form. If we run the sales tax report, then for February here, we got the total amount that's still going to be left, which should, of course, tie out to what's on our payable account. If we think about this in terms of just journal entries, it's a straightforward journal entry. The tricky thing is to calculate the proper amount of sales tax dependent upon when you have to pay it. So you got to go back to January and think about what had been accrued up for January and pay the sales tax through that point in time. Once you make the payments, just like a normal check type of form with regards to the journal entry, we would be debiting the sales tax payable, lowering it, crediting the checking account, lowering it. So that would be looking like this. The checking account goes down. Both the February and year-to-date numbers look the same because they're balance sheet accounts, and the sales tax payable goes down. Both the February and year-to-date are the same because it's a balance sheet account. No impact on the income statement. Again, realize that there's no sales tax expense down here. And when someone asks you that, your answer is yes, there's no sales tax expense down here. That's because when you recharged the sales tax, you didn't include the revenue of the sales tax either. If you're using this type of system, you basically charge the sales tax and put it into the liability account. And the reason for that is because the idea is that the tax is not imposed on you as the business. You're just the collection. You're just the tool that it's charged to the customer. So neither the income nor the expense are hitting your income statement in theory then. So then we have the sales tax payable 2898 was what it was before. We paid off January of a 2344, making it go down to the 554. Notice we paid off the amount that was due, like in our starting balance, because we started over our starting balance for the second month. So this is the balance that was the end of January in our ledger. So that's one place you can look to see where you were at a point in time, the general ledger. And then you got the checking account, which was at 105,722, went down by the 2344 to the 103,378.